if you want to know about how we work, you can see that we have offices in Paris, London, New York, and Hong Kong. We are registered in Hong Kong, in Europe, and also East ACC in the US. We are also member of the RRP, which is a free community of research provider. We want to be, I would say, independent. And we have a lot of well-known and loyal clients. That's the kind of information you can find on internet. So will be your host for this next 60 minutes, and you can have a quick view of my background. So I'm the head of technical analysis. I have the chance to have a lot of very professional and senior technical analysts in London, New York, Paris, and Hong Kong. Okay, so how does Trading Central work? We combine a chartist approach to determine what is the current trend on the market. Then we apply mathematical technical indicator. That's the global idea of what we are doing, and it's based on some very well-known concepts of technical analysis. I mean by that the fact that we believe that the market psychology in the market is doing the market. So we will try to find what is the current feel of the market, what is the current situation, the current psychology in the market, and this will help us to determine what is the current trend. This means that for us, prices reflect all information available on the market, and by using the movement in the market, we will be able to determine what will be the next movement. So the idea is just to focus on the current chart we have on front of us, and this will give us an idea of what is the current situation in the market. Just few history about technical analysis. I won't bother you too much about that. We will run through a lot of examples after. We'll do a lot of analysis, but just to make sure we share all the same idea about what are the bases, what are the key concepts. I just want to remind you about Charles Dow theory, the co-founder of the Dow Jones Index. He assesses different the different bases of technical analysis, and certainly the most important concept, the fact that you have three phases in the market: bullish, bearish, a range. That's very important. And also you need to use volume to confirm the trend. This means that when you see volume, this means that there are people, there is an ongoing psychology in the market. There are some people who are trading. If there are no volume, nobody is here, so you have nothing to analyze. So that's very important. And also he noticed that the trend must be confirmed each between other. I mean by that that when you have a bullish trend on the currency against the US dollar, it means that most of the other currencies will have same kind of trend. So you have to be aware of the consistency in your different analysis. And that's the key concept, which is very interesting, because sometimes when there is an indecision situation, you will be able to, just by using consistency, to determine what is a trend, and this will help in your daily trading. And also the fact that the market is having three phases, this means that there are three waves in the movement. This will help to determine the current maturity, I would say, of a trend. And that's very important, and you can be helped in this kind of task by using technical indicator. And that's why we had a technical indicator to this chartist approach. So, origin of technical analysis. First, we started with Dow Jones theory. Then after, we had some statistical tools, what we call quantitative, that can help technical analysts to do some backtesting to have a better idea of the quality of their prediction. And this also led to the creation of many indicators and oscillators in the market, and this is only possible because we have a lot of computer, we have a lot of calculation power, and we can do a lot of mathematical tests and make sure that what we are doing is relevant, and it's something that the reality can back, and that the numbers can show there is a kind of consistency in doing. Okay, so now I will start with the first concept we will discuss during this webinar, which is the key concept in technical analysis, which is the concept of trends. That's really the main concept in this webinar, but also in technical analysis. When you understand the concept of trends, you can do you have a good basis to do technical analysis, and determining what is the current trend in the market is 70% of your technical analysis. The rest is about finding key levels and also having a look at technical indicators, making sure they are backing your view or not, and you have different criteria to do so, but we will discuss this after. But now let's focus on the key points, which is defining what is a trend. What is a bullish trend? A bullish trend is about successive higher peaks and higher lows. So that's the key concept. You have higher peaks, you have higher lows. And this is the definition of a bullish trend. Anything else that is out of this definition is not a bullish trend. Okay? So that's the first concept. That's the first trend. The second one is the trading range, which is the fact that you have a market that's moving sideways. This means that you are not in the definition of what is a bullish trend, and you are not in the definition of what is a bearish trend, which is the complete opposite of what is a bullish trend. So a bearish trend is successive lower lows and lower peaks. So here you have your bearish trend with successive lower peaks and lower lows. Here you have the bullish trend with successive higher peaks and higher lows, and anything else between is considered as being a trading range. So that's, you can say it's easy, here you are with pictures, but now just let's have a look at what can be seen in the market. We will start with this chart. I think you all recognize gold prices on a weekly basis. And here, what can you see? If I ask you what is the trend on this chart from 2009 to mid-2011, what is the right answer? I think it's obvious for most of you. You can see here on the left of the chart that you have successive higher peaks and you have successive higher lows. So here you are strictly in the definition of what is a bullish trend. So on the left of this chart, it is an obvious bullish trend. Then what can we see after? We can see that there are some difficulties for the prices to move higher. They fail to break above this previous high, but they didn't go below this previous low. So here you can see you have successive, at the same level, top and lows. So you don't have anymore the definition of successive higher highs and higher lows. So now you are in the definition in the middle of this trend. Here you are in the definition of what is a trading range. Then now, if you look at what is happening after we break below this key support, this support is done by key previous low, and you can see that after you have the definition of successive lower lows and lower highs. So on the right, on the left, you have your bullish trend. In the middle, you have this trading range, and on the right, you have a bearish trend. And if you look at recent movement, you can see the prices have difficulties to push lower, but we still register some lower peaks. So this means that we are still in a bearish trend. Okay, so now let's have a look at what is this trend on the euro against US dollar. So it's also a recent chart about the euro against US dollar. And now we will try to determine what is the current trend. So if you look at this chart, I will let you just few minutes to few seconds to determine what is the current trend. And you can see it's relatively obvious if you have in mind what is the definition of a bullish, a bearish trend, and also a trading range. If you have that in mind, it's pretty obvious what is the current trend on a daily chart on the euro against US dollar. So if you look at the chart, you can see that you have your successive movement of higher highs and higher lows. So this is what we can call a bullish trend. Now that we have seen what are the key concepts, but once again, it's really the main concept of technical analysis. We will go through another concept that is, let's say, key for the chartist approach, which is called determining what's the support and the resistance. So roughly, it's very important to have in mind what is a support and a resistance, because from a trading point of view, if you have the directional, there is another point you must be sure to determine, you must have in mind. It is to have an idea of where are the key levels. And you can do that by using support and resistances. So what is a support? Support is just a reference area where you will see that buyer will come into the market and they will buy more. They will trigger, I would say, a disequilibrium between offer and demand. And they will trigger more demand when we are close to this area, which is called a support. So when prices are approaching from this support area, it will trigger more demand, and it will create demand higher than offer, and it will trigger a rise in the price. Because what is a bullish trend, it's just demand that is bigger, that is higher than offer. So if you have this idea in mind, you can see where you can enter in the market, and it's also a good idea to set a stop loss just below this area because you are well protected. I would say that as long as the prices remain above this key level, which is called a support, you have a lot of chance to see further upside. On the opposite, if you see a resistance, you have a lot of chance to see some decline below this key area. So now, just come back to this chart of gold. So you can see here there is an obvious key support, but also an obvious key resistance. I just let you a few seconds to look into it, and after that we will discuss it. Okay, so I think you all have an idea that the 1,530 level is the key support. And if you have been trading in early 2013, you all have in mind what has been happening just after the downside breakout of this key level. I still have this level in mind because it is just like in the book. You know, you see this level, this key level during years because we have seen it since mid-2011, and you see the market that is testing this area several times, and each time it is coming back on this area, you can see that something is not going well. And that's a very interesting situation because this particular situation can really help to understand what is market psychology. So now let's have a look at what has been happening the first time prices came on this key level at 1,530. The first time you can see the market reaction. It is pretty sharp. You can see that buyers entered the market and there were many and they triggered a sharp rebound. That's the first rebound we have seen in mid-2011. Then you can see few months after another test of this area. And you can see the rebound is less sharp. You can see that it took a bit more time to get out of this area, and we also managed to register for a slightly lower price. And here you can see, okay, so current bullish momentum maybe is fading. That's the first warning, very interesting one. And the third time we come on this area, you can see it took a lot of time to draw this rebound, and you can see it took a lot of weeks before we exit from this risky area. And very interesting situation. The last time we came around this area, you can see a rebound before this key level has been hit. What does it mean? This means that in fact all the big ends in the market are not in the market anymore. Here you only have the last mover in the trend. People who took a lot of time to see this level and really they didn't trigger a sharp reaction. You can see there is a small rebound. Then after you can see a massive entry of seller in the market and it trigger a sharp downside movement. And you can make sure that all the people who bought long, who built some long position above this key area, they had been in a situation where they could hold it and they had to sell it, and it added to this bearish move. So that's why understanding what is a key area is so important in the market, because here on an intraday basis there is nothing to do, there is nothing to buy. You really have to be short because really you have sellers who are waiting on the market and they are pushing prices lower and lower. So if you want to make money, you better be with all this trend, all the sellers, and not trying to catch up with this previous level that won't be seen anymore for certainly months. Okay, so that's a very interesting concept. But there are also others that are based on the fact that we can combine what is the trend and what is the support. And they are called channels. Channels is a combination of a trend and support and resistances. So an ascending channel is just a bullish trend between a support and a resistance. So in this kind of situation, you have an ascending channel with ascending support and ascending resistance. You have the range with horizontal support and horizontal resistance, and you have the descending channel with a declining resistance and a declining support. And this kind of situation is very interesting because, once again, if you can spot this kind of situation, you can do some very effective trading. Now I will let you with a blank chart of the euro against Japanese yen on a 30 minutes, so it's pure intraday view of the market. And I will let you a few seconds to see where you can draw a bullish channel and how you could benefit from it. Okay, are you done? Let's go. Okay, so here you can see a bullish channel. How can you draw that? You can draw that just by drawing a line from this point to this one and drawing a parallel. So if you can draw this parallel, you can see that you are able to have 4 points, 4 contact points. So that's starting from here, you are able, starting from that point, your bullish channel is confirmed. Okay, so now what can you do? You can see that you have, on an intraday basis, once again, you have successive higher peaks and higher lows. So successive higher peaks and higher lows. So you are in a bullish trend. That's a fact. Second part of your decision-making process. Okay, if it is a bullish trend, what should I do? Okay, what should be my target? Okay, I want to buy, I want to be long in the market. And that's the first part of your decision-making process, finding the directional. And the second part is about where should I put my stop loss? Well, your stop loss in this kind of situation, it is obvious you have to put it right below the lower boundary of the channel. And the second decision you have to have in mind is where should I take my profit? So if you manage to enter around this area, you take a long, you take a run, then you look at what's happening in the market. For example, you look at where are resistances, and you can guess that around this area you will have to take your profit because it is both an horizontal resistance and also a bullish channel resistance. And you will follow this trend, see this bullish trend, and accompany it just by raising your stop loss along with the lower boundary of this bullish channel. And when you will reach this area, you will take profit and close position and maybe wait for another test of this channel and set your stop loss just below. So maybe you could enter here, but you will get stopped just below because in fact the market trend is turning down. And that's very interesting because if you break this area, you can see that you broke through previous lows and you register new lower peaks and new lower lows. So that's a very interesting situation where you can enter a bullish trend in the market, take your profit, wait for another situation. Unfortunately, we are not 100% right, so sometime you will get stopped out, but it's better to be stopped out with a small loss than staying long in the market waiting for a rebound, because this rebound will just not occur. So in this kind of situation, it's better to have a small loss and taking a big win. And in this kind of situation, if you are only right 50% of the time, because you are winning much more when you are right than when you than what you lost when you are wrong, in this kind of situation, you will be able to benefit from trading in the market and trading currencies. I would like to let you with another blank chart. It's current situation on cable on a daily basis. It's very interesting because on this chart you have two bullish channels. I'll let you a few seconds just to find them. Okay, are you done? Have you seen those two obvious bullish channels you can draw? Or the same kind of situation here, where you can try to benefit from a bullish movement and setting targets and stop losses just by using this bullish channel. And this one is an ongoing bullish channel, so it's a good thing to have in mind when you will be trading cable. Okay, so now we have seen three key concepts regarding technical analysis, regarding charts. It is what's the trend, it is about support and resistances, and it is about the combination of those three concepts through channels. But there are also other parts in the chartist approach. When you are looking at a chart, you can also try to find some what we call patterns. This means that the market is expected to react always in the same way and is expected to trigger some kind of reaction at a certain point. But those concepts, you really have to have them in mind with having in mind the definition of what is a bullish or a bearish trend. If you understand, if you have in mind the definition of a bullish and a bearish trend, you will be able to benefit from what we call patterns. So now let's move to the first kind of patterns you can find in the market. They are called triangle. So you have different kind of triangles. Here I won't try to go through all the different kind of pattern you can find in the market. That's not the point of this webinar. The idea is just to give an idea of what we can do by using technical analysis, and you can try to benefit from patterns, and I will go through three kinds of them. The first one is triangle, and if you understand what is a triangle, for example, let's start with the ascending triangle. It is the idea that before you have this pattern, you have a bullish trend. That's the main concept of the pattern. Before anything, you need to have a bullish or bearish trend, successive higher highs or successive higher lows. If you don't have that before the pattern, there is no pattern. In a trading range, you can't find any pattern because you need to have some disequilibrium in the market. If the market is flat, there is no way to find a pattern. The only pattern you will find in a trading range is a breakout of the boundaries of this trading range. That's all. You can't find in a trading range. If there are no impulsive movements, you can't find a pattern. So before this ascending triangle, you have a bullish trend with successive higher highs and higher lows. Then you can see that the market is having difficulties to register higher highs. But you are still in the definition of this bullish trend because you have halfway, I would say, of the definition of the bullish trend because you have successive higher lows. And what is very interesting in this kind of situation is the fact that once you will have a breakout of this resistance, you will have a very good trend that will be triggered by this movement. And it's a very interesting situation where you can benefit from an up move with setting your stop losses just below the previous low and earning an interesting movement. So here you have an interesting risk reward in this kind of pattern and a good probability of seeing an up move. So that's why patterns are so interesting in the market. Now I will go into certainly the most known pattern in the market. Even if you don't do technical analysis, everybody heard about head and shoulders. Why everybody is talking about head and shoulders? Because they are very interesting patterns. Once you understand what is head and shoulders, you are able to understand the philosophy behind technical analysis or behind a chartist approach. So what is a head and shoulder? A normal head and shoulder is before anything you have the bullish trend. On top of anything you have this bullish trend with successive higher highs and higher lows. Then you can see that you have a kind of momentum, a market dynamic, and you can see that there is a correction, a consolidation that is deeper than the previous one. So that's the first kind of warning. Then you see that you can reach another low, another bottom, which is slightly above the previous low. So you are still in a definition of a bullish trend because you still have those higher peaks. But you have a doubt about what is the next move regarding higher peaks, higher lows. So here you have your bullish trend. Here you have an indecision situation. And when you break below the previous low, what can you see if you skip everything that is here? If you disregard all this part of the pattern, you can see that here you have successive lower peaks and lower lows. This means that this pattern is what? It is just the encountering of a bullish trend and a bearish trend. And when you break below what we call a neckline, here you have the definition of a bearish trend, because here you have successive higher highs and successive higher lows. Then once you break through this neckline, you have successive lower top and successive lower lows. So here you are in the definition of a bearish trend. So this pattern is very interesting because you are trading on the upside, you are adding long position, and you have your stop loss, and you at the time you don't know what is happening in the market. Maybe the trend will reverse, and you don't really know. But if you are in a position to draw this kind of pattern, you know for sure that once you break through the neckline, if there are some volume, if there is a market reaction, you have a good chance to be in a reversal situation. So it's no more the time to be long, to have some long position. It's time to enter some short position. So once again, this pattern is very interesting because it helps to highlight what is the psychology behind patterns. And you can find plenty of them in the market. I will just go through one example. This one, you can see on an intraday basis what is happening in the market. Here you have bearish trend, then you have successive lower lows, lower peaks, and you are in the definition of what is a bearish trend. Then you see that the market is having some difficulties to register a new lower low. And you see that here you have not anymore successive lower lows. So what you must focus on is about the previous top, is about the previous high. If we break through this one, it is a warning that there is a trend reversal, and once you break through this high, this top, you have successive higher top and higher lows. So you are in the definition of what is a bullish trend. So initially you had a bearish one. Then you have a decision-making process, an area where there is some kind of uncertainty, and you can see that once we break through this neckline, you can see that it triggers and that move. So sounds very easy looking at that, but now it's your turn to have a look at the market. Can you see? Can you see them? Can you see some pattern here in this chart? Can you see, let's say, a head and shoulder? Maybe an obvious one, a very obvious one. Where can I see one? Some of you maybe will tell me, okay, here it's obvious there is kind of head and shoulder. But no, look at the neckline. The neckline is descending, so you are not in a definition of what is a bullish trend with a situation of uncertainty. Not at all. So this is not a head and shoulder. A head and shoulder here would be this one. This one with, you can see, you have a bullish trend with successive higher highs. Then you are arriving in a situation where you don't manage to reach higher highs. Then you come back and challenge the previous low. You draw a rebound but slightly above this previous low, and you see that the market reaction is not very sharp. Bear in mind what we have discussed regarding the rebound on the gold level at 1,530. Here you can see a sharp market reaction, a strong one, letting you know that you have people who are entering the market. Here, what about this rebound? There's nothing to do with a sharp rebound you can see here. So you can already guess that something is going wrong in the market. And you see this rebound, it's very far from the previous top. So when you see the market that is trending down again, it is another warning. So you really have to look at this area. And once you see the reaction of the market with trading a lot of time around this area, a rebound that will come back immediately on this level, it is a very interesting warning of a potential downturn. So this one is a very interesting one. Okay, so now, as I said, I won't go through all the patterns that can exist in the market, but I would like to share with you a few more just about double bottom and double top, because we can hear a lot about those kind of patterns and they are very useful. So it will be the last kind of pattern I will discuss. So once again, same kind of psychology. Here you have a bearish trend, then you have an uncertainty regarding the definition of what is a bearish trend. Here you have difficulties with seeing your successive lower top and lower high. So here you have an indecision situation. So you see this bottom, you see this top, you compare it to the previous one, okay, we are good. We remain below the previous top, but here there is an indecision because we are not anymore registering new lows, and you see a breakout above this area. So now you have a warning that something is turning up. You have now the definition of what is a bullish trend, because here you have an up move, here another one, and here another one, and here you have successive higher highs and higher tops. Okay, so now we'll just go through some example. I will let you find the double tops that is not really hidden in this chart. So it's pretty obvious where you can find a double top here. You can draw it with always the ascending neckline, because having a descending neckline on a double top is not fitting with the definition of the previous situation, which was a bullish trend. If you have a descending neckline, you are already in a bearish trend, so you can't discuss a double top. So here in this double top, you have the same situation, difficulties to reach a new high, and you can see the market reaction. You come back on close to the previous bottom area. You can see the reaction of the market. Then once you come back on it, if you zoom on it, so the previous chart was a 30 minutes chart. And if you look on a 5-minute time frame, what can you see? You can see the market reaction on this key area. You can see here, I've been drawing the neckline. It's obvious, the market reaction you can see. And once you see the market reaction here, difficulties to rebound. Then once you break through the area, you can see there is a sharp decline, warning you that it's not time anymore to go long, but it's time to set some short position. Okay, so we are done. We are now done with the chartist approach. Now I would like to run you through some very interesting concepts that will help you in deciding if the once you have determined what is a trend, just by the help of the definition of a trend, but also with the help of trend lines, patterns, of support and resistances, you can have a bit of technical analysis on this. And the first step when you will discuss technical analysis is just about moving averages. Moving averages is a very interesting concept, because if you want to trade, if you want to do some trading, it's very useful to use them just to, as a second, I would say a second guessing of what is the current situation. If you want to trade with a trend, if you want to have in mind that the trend is your friend and you have to trend in the directional of the trend, you better have a strong understanding of what is a moving average. At Trading Central, we always use two moving averages. One, the red one is a 20-period moving average, and the blue one is a 50-period moving average. And when you use them, it will help you to be in the direction of the market. So now let's have a look at this situation. I think you all recognize the situation on euro against the Japanese yen when we draw this bullish channel. But if you use moving averages, you can have the same kind of decision-making process. Here you can see that the long moving average, which is a 50 moving average, is declining and is clearly above the shorter one, which is a 20-period moving average. So here you have the definition of what is a bearish trend. Then when you have an upward breakout of this short-term moving average above the longer one, you have the definition of a bullish trend. And once you break through the with the shorter one below the longer one, you have again the definition of a bearish trend. So here you can clearly identify what is the current trend in the market. So that's very useful. However, we all know that you can't really trade with moving averages only. It's not enough. If you want to assess what is the current risk in the market, it's not enough to have moving averages. Moving averages will help you to define, to confirm what is a trend, just to make sure you didn't have a look at something and say, okay, yes, it's the definition of a bullish trend. But no, if you look at your moving averages, if they are ascending, it's a bullish trend. If they are descending, it's a bearish trend, and that's all. There are no further discussion. Okay, so now what can you do with technical indicator to, I would say, fine-tune, to have a better understanding of the risk in the market? There is a very interesting tool in the market which is called the RSI, which is a relative strength index. It is a relative strength between buyer and sellers. That's this definition, just the idea of a relative strength between long position in the market and short position in the market is very good way to assess what is the current risk. It is a good way to gauge what is the strength or of the offer side of the market and what is the strength of the demand side of the market. So how can you use oscillators? Well, there are several ways to use them. You can use them just by trying to find some lines on them, and they will give you an idea of what is the current trend. For example, here you can see a bullish trend with successive higher highs and higher lows, and here you can draw a line on the RSI, letting you know that yes, you have a confirmation of what is happening on your chart. And what is very interesting, it is when you will see some discrepancy between inconsistency between what is happening on your RSI and what is happening on the chart. For example, if you see here some kind of bearish divergence, meaning the prices is registering new high while your RSI is not, well, here it's not very good one chart, but we will see that after. It's a very interesting warning, and you can see that once you break through the rising trend line, it is also a warning that you can have a reversal in the market. And last but not least, let's discuss about what we call oversold and overbought area. Very interesting tool, because it will let you know when there is a risk reversal, and that's very interesting, but very, very interesting. So just a quick remark regarding overbought or oversold. When you hear the market is overbought, it doesn't mean that there will be a reversal. An overbought market is a risky market. It is just a risky market. It doesn't mean you have to stay out of the market. It just means that you have to narrow your stop losses because there is a risk of a sharp reversal. So if you hear that a market is overbought, it doesn't mean you have to sell. It just means that you can stay long, but you have to narrow your stop loss because you are in a risky area. What is an overbought market? By using an RSI, it's very easy to define. It is when your RSI is above the 70 area. The RSI is moving between 0 and 100. When it is above the 70 area, it is an overbought market. When it is below the 30 area, it is an oversold market. So here on the overbought area, it means that we have gone too high, too far, and there is a risk of a sharp reversal, a sharp bearish reversal. And when you are in the oversold area, it means that we have been down too fast, too far, and there is a risk of a rebound of people who were short and who want to take profit, and they will close their short position and take their profit, and they will trigger the opposite reaction. Okay, now just come back to the euro against Japanese yen chart. Here, what can you see? There is a mix of indicators. You can use your moving average to assess the current situation in the market. Here you have a bullish trend because here you have a moving average short one, which is above the longest one. Here what you can see is once you have drawn your bullish channel, you can see that you have a downturn on moving averages. You can also see just by looking at the RSI that you are in the overbought situation. But here you have a warning, beware of the situation. You could have a reversal, so you have to narrow your stop loss and you have to take care of the situation. If you are close to the upper boundary of your bullish channel, take your profit and wait for a better time to enter, because there is a risk of a reversal. Same kind of situation here. Here you have a downtrend, and you can see here you enter in the oversold situation, so there is a risk that this bearish trend will come to an end. So it's very interesting. So it just means that you have to narrow your stop loss, because if there is an adverse movement, it could trigger a downturn in the market. And also another way to use them, it is just by drawing lines. As I said, you can draw lines that will reflect the current trend in the market. You have a bearish trend here, you have this bearish trend line here. You enter the oversold area here. There is a first warning that something could happen. There could be an upturn in the market, and once you break through this trend line, you have the confirmation of this upturn. Same situation here. You have this bullish trend with successive higher highs and higher tops. You can draw the reflecting rising trend line that will completely highlight this situation. And once you arrive in the overbought area, it is a warning that something could happen, and if you break through this trend line, it is another warning that you could have a downturn. So as you can now figure out, I guess, with my explanation, the art of technical analysis is about combining the different tools we have. It is just to make sure that you can have some better buy and sell signals and find them more relevant if you confirm them between each other. And the advantage will be to reduce false signal, optimize your timing, and improve your price targets. Bear in mind the upper boundary of this rising channel. When you are approaching this rising channel upper boundary, it is time to take your profit, and it will help you with price targets. And also you have to combine different time scales. You can't trade on a intraday basis without knowing what is the current situation on a daily chart and sometimes on a weekly chart, because you can't go against the trend. And if you look only at the intraday trend, you could be against the daily trend. So it's very important to know that. It will help you to have an idea of the current risk you are taking in the market. And for any signal, the greater time scale, the better signal. And it will help you, once again, to validate your different indicators. So we have now a few minutes left. I will just run you through an analysis on the cable. So we will start with a weekly chart. Here's a weekly chart. You have an obvious situation where prices broke above a key declining trend line, and we are in an ascending channel with it, and we have prices supported by the 20-week ascending moving average, which is fitting with the lower boundary of this ascending channel. So here you are in a bullish trend, but you have a kind of warning because you are approaching the overbought area, and you rose through the upper boundary of the Bollinger Band. If you look at the cable on a daily basis, you can see that prices struck against the upper boundary of this rising channel. So now you can have in mind that something is going wrong in the market. You have a bullish trend, but if you have to trade on a trade basis, you can, I would say, more trade on the shorter side of the market than on the longer side of the market, because there is a downside breakout of this ascending moving average, and you can see that the RSI is turning down and is going into the selling area because it is below the neutrality area. And now we will look at the current situation on an intraday basis on the cable. So on the cable, that's the intraday chart you can see. And here, what can you figure out? What is the current trend here on an intraday basis on the 30-minute chart? This is a chart I did yesterday evening. Here you can see there is successive lower lows and lower high. You can see that you have, on the very short term, you have some declining moving averages if you look at the 50-period moving average. But you can see that here you are close to the oversold area. You can see also that there is a downside breakout of the previous bottom. So you have successive lower lows, successive lower highs. And if you look at technical indicators, here you can see the validation of what we call bearish divergence, because we enter in the overbought area and we had higher highs on the price, while we can't see that on the RSI. So it's a warning that something could go wrong. And you can see that on the RSI you have a small definition of what could be a bullish diversion. So it's a warning that you could see a rebound, but if you are an experienced technical analyst, you know that this kind of diversions coming just after a sharp decline, they are not really relevant. They will just let you know that there is a potential rebound in the cards, but it will be a limited rebound. And if you look at the previous area, you can get that this area is a very good place to set a stop loss, because if you break through this previous bottom, it will trigger an upward breakout of the moving averages, and you will have your RSI entering into the bullish area. So what would be Trading Central analysis on this kind of chart? It is a bearish analysis where we think that the current bearish trend will continue, and we guess that below this key area, which is our invalidation level, what we call in our technical analysis our pivot point, as long as we remain below this area, there are some further declines in the chart based on the methodology I explained before, because there you have a bearish trend, you don't have the very strong bullish signal because this bullish divergence is not good enough, and you still have some declining moving averages. So a quick explanation of what we call a pivot point. Pivot point for us is the invalidation level. This is from where we start our analysis. We try to find the turning point in the market, and we want to make sure that this level, if it is broken, will completely invalidate our analysis. So this is why we start our analysis with the pivot point. Conclusion about this webinar. So I expect that you have seen a lot of interesting concepts, but the main concept is having in mind that technical analysis can be used on a daily basis, can be used on a intraday basis, can help in trading and setting levels, and I would say before everything, it can help to assess the current risk in the market just by looking at the momentum and having an idea of what is the current psychology in the market. And it helps to enter long or short position. So if you want to find some of our technical analysis or of our technical view, you can log into Exness website, and you will see the different analyses we provide. You can run through them on the website, and you will see our reports that are like that with what we want. We try to make it as clear as understanding as possible. We start with our pivot level, which is our invalidation level. We have a clear view. We say long position above an area, sell position below another one, and we have an invalidation level that can be really understandable. And we also, you can also see a quick view of our analysis just by looking at briefly on the feed of technical analysis. And last but not least, we also have some journalists on the New York Stock Exchange that are filming some video every day where they will discuss our view. For example, here you can see the view we provided on the euro against Japanese yen, and we did it on video, and you can watch this video on the XNES website. Well, thank you very much to all. I hope you had a view of different interesting concepts. Now we will take time to answer some questions if we have some. Julia, did we receive some questions from the attendees? So there is a question regarding the RSI red line on our chart. So I will just come back on the chart we use. Just go back here. There is a red line on the RSI. As you can see, we try to explain everything we do. So here it is an RSI 14 periods with a 9 period moving average. So the red line, it is the 9 period moving average. It is the most common setting on the RSI that you can find in all books. So we don't change it. Regarding that's an interesting question, because every time we explain what we are doing, we always have some questions about what are the best moving averages, what are the best settings for RSI, what are the best settings for moving averages, should I put 21 or a 46 moving average? Well, before anything, the first thing you have to do is looking at moving averages, always the same setting, just to make sure your eyes will learn about situation in the market. And if you keep on changing settings on your technical indicators, it will be more and more difficult for your eyes to notice some movement in the market. So it is very important to keep the same setting when you are doing technical analysis. At Trading Central, we keep always the same setting. We always have 20 period in red, 50 period moving averages in blue, and between the 20 period moving average, we have the Bollinger Bands, which are 2 standard deviations between the moving average. We also have an RSI, which is 14 period with a 9 period moving average. And on all our charts, you can see the pivot point, which is the invalidation level. It is always in blue, and you have resistances in green and support in red. We always have the same setting, just to make sure people who are reading our technical analysis don't have to make the analysis. So we don't want to get them confused. That's why we draw the arrow, we draw the invalidation level, and we write very few text about the technical analysis. We assume that just by looking at the chart, they can have a good idea of what we want to explain, of what we want to say, because they have the directional, which is obvious just by looking at the arrow, and the invalidation level just by looking at this blue level. Okay, so I think we are a bit running out of time. Sorry for taking more time than initially scheduled. It was a pleasure to explain the way we work at Trading Central. If you have other questions, feel free to send them to the organizer, and it will help us to set maybe some other webinars in the future. So thank you, and good trade, and you can see our analysis on the XNES website. Have a good day and good trading. Bye-bye.